Let's go ahead and get started then. Happy Friday, everybody. Welcome to our weekly Outlook webinar. My name is Ilian Yotov, founder of allthingsforex.com, creator of the Quarters Theory. You're welcome to check out my foreign currencies trading method, published by John Wiley & Sons. I'd like to thank our friends at fxstreet.com for putting together the list of the series of webinars. And what we're here today is to gather to discuss the trading week ahead of us and prepare for the top 10 spotlight economic events for the new trading week that we witnessed today. This week we saw Italy coming to the forefront of the debt crisis, the Italian bond yields reaching the so-called breaking point above 7%, levels that, according to experts, are going to be unsustainable for Italy to continue to service successfully their debt. And we're seeing a little bit of a sense of calm in our last couple of trading sessions here. The euro strengthening a little bit, an optimism that there's changes, positive changes happening with the governments in Italy and Greece. However, I cannot help but maintain my pessimistic outlook, especially if the market next week decides to focus, if you will, on economic data rather than headlines from Greece and Italy. Without a doubt, the bond markets are going to be important. The Italian bond yields, if they continue to rise, obviously that could put additional pressure on the euro. We have a vote from the Italian government that is coming up on debt reduction measures intended to help investor confidence that they're going to be able to deal with the crisis. Problem with Italy, as many of you know, is that it is too big to fail, but on the other hand, also too big to bail out. How a potential bailout is going to happen, especially if the Italy now is being forced to ask for a bailout, 1.9 trillion, almost 2 trillion euros of debt for Italy alone, with only $1 trillion promised for the EFSF, the temporary bailout fund, not even completely full yet. Today, the Financial Times, citing the chief of the EFSF fund, saying that it was always, quote, ambitious to have that 1 trillion euro number, but he said, I'm not ruling it out. In other words, we might be able to pull it off and fill that fund with up to $1 trillion euros as promised. In reality, however, estimates are that there's only 250 billion in it available. So, a lot of issues, obviously, still for the Eurozone. There's still a lot of uncertainty. And as long as that continues to be the case, the euro could continue to stay under pressure. Now, heading into next week, the very first spotlight event that we'll pay attention to is going to come from Japan. And we're going to see next week the main gauges of economic activity and growth in Japan and also in the Eurozone. We'll start with the Japanese gross domestic product on Sunday night at 6:50 p.m. Eastern Time. Many of you would recall that in the first and the second quarter of 2011, the Japanese economy registered its third recession in the last decade, largely due to the devastating impact of the earthquake and the tsunami in Japan and the nuclear disaster there as well. In the second quarter, the Japanese gross domestic product showed a reading of minus 0.5%. That means a contraction of 0.5%. However, the consensus forecasts are now expecting the Japanese gross domestic product for the third quarter, preliminary estimate, of course, for Sunday night, for the third quarter GDP, to show the Japanese economy returning to growth by up to 1.5% quarter over quarter. And this could be a positive report there. And if economic conditions in Japan continue to improve, the Japanese yen, especially if that's coupled with more risk aversion, which ultimately increases the flight to the relative safety of the Japanese yen and strengthens it, the Japanese yen could continue to push a lot of other major currencies lower, and in particular, the US dollar. Now I'm going to switch us over to the daily chart of the euro-dollar currency, of the dollar-yen currency pair, to show you a couple of very interesting things. Note the two significant spikes here. For those of you who have not been paying attention to the latest news from Japan. We had a recent intervention that was produced by the Japanese Ministry of Finance, and the Bank of Japan normally acts on behalf of the authorizations from the Ministry of Finance. That intervention happened right there where you see the spike on October 31st. Once again, Japanese authorities felt that they needed to intervene after the U.S. dollar established a new record low versus the Japanese yen into what I have been saying all along, but last week we didn't have this usual webinar on Friday because FX Street has another non-farm payrolls webinar. So had I been here last week, obviously I would have brought your attention to the prospects for that it's getting close to a potential intervention for us to witness from the Japanese authorities. Indeed, that was the case, and I have been talking about that especially as I called the dollar-yen currency pair approaching and entering that what I called intervention zone between 75 and 76 yen. And now you might recall that the Bank of Japan intervened on October 31st after the dollar established a new record low versus the Japanese yen at 75.55 yen. It produced, if you listen to my daily program, the All Things Forex broadcast, you don't have to wait, obviously, for Friday's Outlook webinar on a daily basis on my website, allthingsforex.com, and the broadcast is syndicated on fx3.com and about 12 other websites out there that publish foreign exchange currency-related content. But you can find the archives, you can listen to the broadcast live or the pre-recorded on allthingsforex.com or fx3.com. So what I was talking about on a daily basis is the potential foreign intervention, and I estimated, based on previous moves and spikes for the dollar against the yen, what the size of the move for the dollar against the yen would be as a result of a Japanese authorities' intervention. And I estimated anywhere from 300 to 400 pips. That's pretty much what happened after the intervention occurred here. Not too long ago, on August the 5th. Now, on August the 5th, we saw the Bank of Japan stepping in, intervening once again. We saw a move from the lows at that time, 76.97 yen, to about a little bit over 80 yen level. So it's about 300 pips, 350 pips of a move to the upside. So I was expecting anywhere from 300 to 400 pips, and the move after the latest intervention by the Bank of Japan was about the same. It was about 400 pips. From as low as 75.55 yen to 79.52, right? The problem is, however, when it comes to the dollar, is that the U.S. dollar is now doing exactly the same thing that it did after the previous interventions. And that is a spike, 300 to 400 pips, and then in the days and weeks to follow, the dollar simply reverses again, erases its gains versus the Japanese yen, and it goes to establish new all-time lows. In the last couple of weeks, we're witnessing, especially throughout this week, we're witnessing exactly the same development. The U.S. dollar is erasing now more than 200 pips of its 400 pip approximate gains, post-intervention gains, versus the Japanese yen, and it's now trailing slowly but surely towards the 77 yen area. Why is that important? It is important because, obviously, looking at what's happening, the intervention by the Bank of Japan was not effective as far as keeping the Japanese yen persistent strength under control. And throughout this week on my program, the All Things Forex broadcast, I've been explaining what would be if I were a Bank of Japan or a Ministry of Finance policymaker, what I would have done, which to me it's the common sense. That would be intervening somewhere around these levels ahead of the record lows or ahead of the intervention zone, as I called it, between 75 and 76 yen. Making a smaller intervention, the latest one estimated by Barclays and other financial institutions, they said we're estimating it that it's about 8 trillion Japanese yen. So it's a significant amount of money that the Bank of Japan threw at the latest intervention to curb the strength of the Japanese yen. Now, if they wanted to send a message to the markets that this time they are serious about this and that they are committed to continue to curb the Japanese yen's gains and prevent it from doing what has happened after previous interventions, a short spike higher and then Japanese yen continues to strengthen further, pushing the dollar to new record lows. If they wanted to send a message that this time around they want it differently, then they would have to intervene, I think, somewhere around these levels. Now, again, this is only my humble opinion. But the reason why explaining such a scenario is because it makes sense. To me, it makes sense. And you shouldn't be surprised if we get to see an actual intervention ahead of the previous lows, before these previous lows are being reached or new lows are being produced. Now, that's, of course, only my opinion. It's important next week also to find out, with the Bank of Japan's interest rate announcement coming up Tuesday night, early Wednesday morning, where do they stand? Provided they, of course, haven't intervened before that, because there will be a couple of trading sessions before their meeting, during which they could possibly intervene again, if they wanted to show commitment and sign up that this time around they wanted things done differently and they want it done right. Now, provided they haven't done an intervention before Tuesday night, Wednesday morning, it'll be interesting to me at least to see what the Bank of Japan is going to say. That's another important economic event from Japan for next week. So it's not really about any technical developments, any trends when it comes to the dollar yen. Obviously, the Japanese yen trend is still very strong and it's still intact. And it can only be reversed if the U.S. dollar is either able to stand on its own feet, which might be a difficult proposition with the U.S. having its own problems, QE number 3 by the Federal Reserve still not completely out of the picture. And then on top of that, if risk aversion flows continue to favor the relative safety of the Japanese yen compared with the U.S. dollar, we could have further continuation of the Japanese yen strong trend. So the only option right now that is more viable for Japanese yen to weaken is more interventions. And we'll see whether the Japanese authorities, Ministry of Finance, and the Bank of Japan will continue to intervene in the markets. Finance Minister said that he's going to continue intervening until, quote, satisfied. What is the level? That's what I want to find out. What is the level that will be satisfactory level that the dollar-yen exchange rate would reach? What's the target? We'll see. That's what we'll watch next week. Also interesting next week is going to be a sequence keeping the spotlight on the British pound throughout next week. Is going to be a sequence of important economic data from the United Kingdom. Consumer Price Index is coming up on Tuesday. We have the Bank of England's inflation report on Wednesday. We have the jobless claims and unemployment rate from the UK also on Wednesday morning. And also on Thursday, we have the United Kingdom's retail sales, which is an important measure of consumer spending. That sequence of UK economic data is going to start with the United Kingdom's Consumer Price Index, the main measure of inflation preferred by the Bank of England. Obviously, the Bank of England, despite of the rising inflationary pressures, has no other choice but to be accommodative with their monetary policies, not only keeping the interest rates at the record low level at 0.5%, but also, as we recently noted, increasing the size of their quantitative easing program, the so-called asset purchase program, by another 75 billion pounds, now to a total of 275 billion pounds. Yesterday, the Bank of England decided to keep the status quo, no changes in the benchmark rate, no changes in the size of the program, and it's interesting to see whether or not the Bank of England will either expand the size of the program or reduce it, as the latest minutes report had shown us that the Bank of England is considering that that's an option. Adjustments in the size of the program, they said, could be made as necessary. In other words, if UK economic conditions continue to deteriorate and the economy, there's a threat of a double dip or contraction, the Bank of England could decide to expand the size of the quantitative easing program, which could continue to weigh on the British pound. On the other hand, as I have been saying in the last several weeks, although it still might be a bit of a long shot, but if the Europeans actually manage, again, that's questionable, but it's a scenario we should be aware of. If the Europeans actually manage to put a firewall to contain this debt crisis, and ultimately that would be positive for the United Kingdom's economy. As we know, recession in the Eurozone would hurt the demand for UK exports, considering the fact that the United Kingdom's largest trading partner is the Eurozone. Ultimately, if that is a scenario that happens, and the Eurozone does not go into contraction or recession, and the UK economy strengthens, then the Bank of England may not need to either expand the size of the current program or maybe even consider reducing it. Again, it is a long shot at this point, but it is a scenario that we need to consider going forward. Dependent also on the UK economic data and inflation output for the Bank of Japan, we know that the Bank of not the Bank of Japan, the Bank of England. We know the Bank of England's policies are going to be also impacted by where do they see inflationary pressures. And obviously the Bank of England in the previous assessments have estimated that in a short run, inflationary pressures will continue to increase, but ultimately in 2012, 2013, the coming couple of years, inflationary pressures will begin to subside, ultimately reaching the desired levels. For pretty much any central bank, the target inflation range is between 2 and 3%. They don't want to see it above 3%. They want to see inflation as close as possible to 2% level. And the Bank of England is no different. 3% is the ceiling of the Bank of England's preferred inflation level. Problem is that throughout this year, inflation has been stubbornly high, and most recently it rose to as high as 5.2% in September. Now, the consensus forecast for next week's consumer price index on Tuesday are expecting a little bit of a slight pullback in inflationary pressures. The consumer price index is expected to pull back a little bit from 5.2% to 5.1% year over year in October. I actually would not be surprised if the pullback is even larger, towards 5 and maybe even below 5%. And the reason why I'm saying this is because if you paid attention to the producers' pricing, which was reported earlier this morning from the United Kingdom, the producers' price index is so-called wholesale inflation gauge experienced by producers that ultimately gets passed on to the consumers, impacts the consumer prices. So we saw a larger than expected pullback in producers' prices, which is a leading indicator of consumer inflation. So I wouldn't be surprised because of that to see a little bit bigger of a pullback in the consumer price index in the UK. So what does that mean? If we get to see inflationary pressures beginning to subside, then the Bank of England will have lesser urgency to start tightening monetary policy anytime soon. Now, heading into next week, we're seeing now the British pound, and I'll switch us over to the daily chart of the pound-dollar pair. We're seeing the British pound finding some strength in the trading session today. Yesterday, it tested an important level of support from last week. And that level of support was, I'm going to put the line right there and point to that level. That was $1.5875. $1.5875, the low from November the 3rd, last week. We tested that level and overshot about 7 pips below it with an intraday low today, or yesterday rather, at $1.5868. So it was an attempt to produce a breakout, but to me, I would not classify that as a decisive breakout. I require a bit of a more decisive type of a price move to consider that as a decisive breakout. So heading into next week now, the pound is bouncing off of that level and it's moving towards the $1.60 area, overshooting $1.60 as we speak, with an intraday low, intraday high so far at $1.60.23. It's going to be interesting to find out, does the British pound break outside of this range that has been established in the last couple of weeks? I'm bringing down this line here so that I can show you what looks to me as the top of the existing range. Now you have these identical lows in a vicinity of a little bit below $1.59, $1.59.68, $1.58.68 and $1.58.75. And then you have, change in the charts, going back to the pound dollar pair. And then you have the top of the range, the high from last week, at $1.61.65 from October 31st. That, give or take, is about a little bit less than 300 pips of a range. So obviously in the last couple of weeks, the pound dollar pair is trendless. It is stuck in a range, and only a break either above the top of this range or below the bottom of this range could give us a more definite trend direction as to where the market wants to take the pound-dollar exchange rate. The middle of that range is approximately the $1.60 level. Without a doubt, that's an important price level, especially in my quarters theory. It is what I call a major whole number. It is a major large quarter point, and it is an important junction that separates two 1,000 pip ranges. Now, the previous 1,000 pip range for the pound dollar pair was the one it fell from during the significant decline that we saw in the month of September. The pound dollar pair, as we discussed on this program, on a weekly basis, produced what I classify, and I explain all of these methodologies in my book, The Quarter Theory, what I call a 1,000 pip range transition. It's an important development where the currency pair's exchange rate falls from a current 1,000 pip range and transitions into a new 1,000 pip range. It either falls or goes into a new one above. In the case of the pound dollar pair, the 1,000 pip range transition was falling from the $1.60s, or the 1,000 pip range between $1.60 and $1.70, transitioning its exchange rate into the $1.50s, or the 1,000 pip range between $1.50 and $1.60. Obviously, with the pound-dollar trend direction not clear, lots of uncertainty, no clear trend direction, it is not unusual for prices to linger around the large quarter point, major large quarter point, especially such as the $1.60 level, the dividing line between the two 1,000 pip ranges. So a break either above the top of this range or below the bottom of this weekly range is also going to give us a hint as to which 1,000 pip range does the market want to keep the pound-dollar exchange rate in, the $1.60s or the $1.50s. And based on that hint and that clue, we can anticipate further progression into either of those two ranges, either further into the $1.60s or further down into the $1.50s. That is what I'm expecting to see next week. I would like to bring to your attention, and I'm going to jump the gun here while your image of this development is fresh in your hands, and switches very quickly to the euro-dollar pair. Now, in recent months, throughout September, I brought your attention and gave you an example of what I consider leader-laggard relationships between the euro-dollar pair and the pound-dollar pair, especially in terms of my quarter theory methodologies and the 1,000 pip range transitions. The euro-dollar pair was leading the developments with these 1,000 pip range transitions. It transitioned its exchange rate from the $1.40 into the $1.30's 1,000 pip range days, if not even weeks, before the pound-dollar pair did so. But as I brought to your attention at that time, if one were applying these methodologies that I've created successfully, one could have recognized this relationship, and the fact that the pound was being a laggard created opportunities. In other words, with the pound lagging days and maybe even a week or so behind the euro-dollar pair, but following ultimately the same direction, the same footsteps of the euro-dollar pair, the pound-dollar pair followed right along, and it also transitioned its exchange rate from the $1.60s into the $1.50s, ultimately falling to as low as, you might recall, the large quarter point area of $1.5250. Now, those of you who are tuning in for the first time and scratching your heads going, what in the world is this guy talking about? 1,000 pip range transitions, large quarter points, and so forth. Pick up my book or watch previous webinars. Now, I wanted to jump the gun a little bit here and show you the euro-dollar pair, where we may be seeing the same type of leader-laggard relationships that are developing again between the euro-dollar pair and the pound-dollar pair. Remember me showing you just minutes ago the range, weekly range that was being established there for the pound-dollar pair? Well, the euro-dollar pair did that same similar development in the recent week or so, where with a range that was being established. The bottom of the range was the $1.36 area with the low at the $1.3608 on November 1st. And then the top of the range were some identical highs around the $1.38.5 area, in particular this highest high, which was $1.3868. Now that the euro yesterday and the day before broke below the bottom of this range, I think it's giving us a bit more of a definite trend direction finally after that breakout. Now, obviously, on price correction and optimism today, the euro is jumping back into that previous range. So that's a range that we should watch as well. Both of these currency pairs, euro-dollar pair and the pound-dollar pair, have very similar developments as far as trend progression is concerned, with the euro giving us the hints here that it may be breaking a little bit more decisive, which ultimately, if the market takes that direction again below the bottom of this range next week, we could see further weakness for the euro, and ultimately the British pound could also follow. We know that the pound is more than likely not going to stay immune if more risk aversion hits throughout next week and if pessimism sets in again. But that's what I wanted to show you while your memory was fresh of the pound-dollar chart. I wanted to show you the range there, weekly range of the euro-dollar chart, which was already broken yesterday, and the euro fell to the large quarter point of $1.35, tested that support level from September. I don't think you really thought that this was a coincidence that was happening in a trading session yesterday. Large quarter point, $1.35 was serving as a level of support. It was overshot by 3 pips in September on September 13th, when the euro-dollar pair reached, or 2 pips. Now, 3 pips or so. $34.97 was the low on September 12th. So that level was challenged, was not broken below. The euro bouncing off of the support around $1.35. In terms of my quarters theory, I also want to bring your attention to the euro-dollar developments. In terms of my quarters theory methodology, I divide every 1,000 pip range. There's clearly defined constant ranges, never changing, constant ranges of 1,000 pips. When you think in terms of the 10 cents ranges between two whole numbers, such as, let's say, $1.40 and $1.50 or $1.30 and $1.40. Those are two major whole numbers, represented, of course, with decimal notation. The distance between these two whole numbers is always 10 cents. In terms of price interest points, that's 1,000 pips. So with my quarters theory, I divide each 1,000 pip range into exactly 4 equal parts, or what I call 4 large quarters of 250 pips each. And I propose that prices move and fluctuate not randomly, not chaotically, but rather in an organized manner in a systematic effort to complete the large quarters and produce moves from one large quarter point, targeting another large quarter point, also in a systematic effort to ultimately complete the entire 1,000 pip ranges, quarter after quarter after quarter. So there is a familiarity, there is a predictability that I have created with this methodology. Familiar price ranges, never changing price ranges, constant ranges of 1,000 pips or 250 pips, and fluid moves that happen, not chaos, not randomness. That's the essence of what my quarters theory is all about. So in terms of my quarters theory, the move that we saw for the euro on this rally throughout the month of October, the optimism, I called it the quote, better late than never optimism rally. So on that move, we see the euro going as high as 1.4247. If you recall, that was the high on October 27th. Do you think that this was a coincidence, or was there a large quarter point there that was being targeted? Well, if you follow my methodologies, then you know that the large quarter point, $42.50, was an important price level to watch. And the euro stopped 3 pips, or to be exact, 2.5 pips below it. So in terms of my quarters theory, with the euro falling as of yesterday, a little bit below $1.35, there now has been, on this decline in the last couple of weeks, the euro has completed 3 large quarters of 250 pips each, falling from $42.50 to $40, $40 to $37.50, and then $37.50 to $1.35. How about that for complete chaos and randomness? So on this price correction now that's happening for the euro-dollar pair, if the euro-dollar pair lost 3 large quarters, which equals to 750 pips approximately, could the euro correct 1/3? If the euro were to correct 1/3 of that loss, then prices could go back up to the large quarter point at the $37.50. So in the intraday session yesterday, in a research note to their clients, UBS Wealth Management said that the euro-dollar pair was establishing, quote, meaningful resistance around $36.5 there. Now, I wouldn't really go as far as saying that that resistance was that meaningful, because, yes, yesterday the high was $36.53, but it wasn't like it was establishing a strong resistance at that level for a number of days. As a matter of fact, in a trading session today, that, quote, meaningful resistance area at the $36.50 was broken successfully above. And if you listen to my All Things Forex broadcast, which started a couple of hours ago, I did it live from my website, allthingsforex.com. I spoke that if the euro was looking like it's going to break above UBS's meaningful resistance level, and it could very quickly go to the large quarter point, which obviously is an important price level in my quarters theory, at the $37.50, expanding its price correction that started later on in a trading session yesterday and throughout the trading session today. Well, as we speak, the euro is already peaking with a new intraday high at the $37.18. So getting closer to the area, at least within 25 pips of the targeted large quarter point at the $37.50. So 1/3 approximately of this, the euro's losses have already been corrected. And if the market decides to go with a larger price correction, the hint of that would be given to us if the euro breaks successfully above the large quarter point at the $37.50. If that were to be the development that happens going forward into next week, then we could possibly see the euro even challenging the top of this range, that it is re-entering again. Again, the top of that range would be $1.3868. So that would be interesting to see heading into the upcoming trading sessions, especially considering that we have a list of important economic reports from the Eurozone next week as well. As a matter of fact, right after the United Kingdom's Consumer Price Index report, 30 minutes later, we're going to see the Eurozone Gross Domestic Product report, the main measure of economic activity and growth for the third quarter, preliminary estimate for the third quarter of 2011 from the Eurozone. And that GDP report, preliminary estimate for the third quarter, is expected to show the Eurozone economy growing exactly at the same pace that it did in the second quarter of 2011. That means by only 0.2% quarter over quarter. That's a very minimal economic growth, in case you were wondering. In other words, what I'm trying to say is the Eurozone GDP report could show signs of weakness in a Eurozone economy, something that would not be necessarily a shocking development, especially for those who have been paying attention to not only headlines from Greece and Italy, but also economic reports from the Eurozone. On Monday, before the GDP report, we're going to see the Eurozone industrial production, which is expected to be also another disappointing report, if provided, of course, the consensus forecasts are accurate. In September, the Eurozone industrial production was up by 1.6%. It is expected to decline by 2.1% with a report on Monday at 5 a.m. Eastern. So if we have to count the number of negative economic reports that come next week from the Eurozone, provided, of course, the market pays attention to them, and not just headlines from Italy and Greece, we could see more signs of weakness in the Eurozone economy, in line with the growth forecasts that are being estimated for 2012, very much of downward revisions there for Eurozone economic growth. Some financial institution economists even forecasting that the Eurozone economy might see a recession, a mild recession, but a recession nevertheless in the upcoming year. So the Eurozone industrial production could be lower according to the forecast. Eurozone third quarter GDP growth only 0.2%, same as the second quarter. And then also at the same time as the 5 a.m. report GDP preliminary estimate, we're going to see the ZEW Institute, the German ZEW Institute, and their economic sentiment index, which is also expected to show an even larger decline in economic sentiment. The reading of minus 51.7 is the consensus forecast, compared with minus 48 in a previous month. So all of these events, again, I have to use this disclaimer because that has not been the case so far. It was all about the debt crisis headlines from Italy and Greece. If we get to see the market focusing on economic data, do not be surprised if these become risk events for the euro throughout next week's first couple of days at least, when we see the more signs of weakness from the Eurozone. So in other words, what I'm saying is, as I was showing you, the euro is going through some price correction of its losses in the last couple of weeks versus the dollar. After the price correction is over with, especially if the euro finds resistance at these previous resistance levels, top of the range that I was showing you around $1.38.5, if it stays below these levels, don't be surprised to see further euro weakness, especially if the negative economic reports are coupled with more risk aversion, more negative news, and more further increases in Italian bond yields. The auction yesterday, some people say it was successful. I cannot help but be a little bit pessimistic. It was the yields that were asked for 12-month auction yesterday were almost twice as high as they were just a month ago. 3.5%, if I'm not mistaken, were the yields that Italy sold 12-month bonds in October. Yesterday's auction, so Italy selling the same maturity government bonds for 6.09% from 3.57% of the previous sale in on October 11th. So obviously, yields are rising. Investors continue to demand higher yields, and these are levels that, according to experts, are not sustainable. And the participation in yesterday's auction was also, I don't know if it were that successful. Reports were publishing yesterday that saying that the Italian government ordered Italian banks to buy the 5 billion euros that were being auctioned of 12-month treasury bills, along with the European Central Bank, which is still the major buyer of Italian government debt. On Monday, put that on your calendars as well, heading into next week, Monday, Italy plans to auction another 3 billion euros of 5-year bonds on November 14th, which is Monday. Now, that's going to be another test of investors' demand for Italian government debt. If there's lack of such, and Italian banks and the European Central Bank are the main buyers of Italian debt, I don't know if we can call that very successful of an auction. Now, the European Central Bank has now been called from a number of places to stand up and be the lender of last resort. So far, a lot of European Central Bank board members have said that that's not in a mandate of the European Central Bank. The main mandate of the European Central Bank is to ensure price stability, not to buy government bonds of debt-ridden nations. If that mandate, however, changes, then I would consider that as a euro positive. And if in the weeks ahead, I'm not saying we're going to hear it in the next week or two, but if it's a scenario we should be aware of, if that's the kind of announcement that we hear, obviously that could cause and lend support for the euro, which might be a short-term development because in the long run, obviously, the European Central Bank is going to have to print a lot of money to be able to buy trillions and trillions of dollars of the debt of the troubled nations. But in the short run, it could be considered, it could become a catalyst for a euro relief route. Now, after the Eurozone GDP report, we're going to start the sequence of U.S. economic data with the retail sales. It's an important gauge of consumer spending, and the U.S. economic data, looking at the consensus forecast for next week, looks to me more of a mixed bag. And as long as there's a mixed bag of economic data which lacks strength, we know that the Federal Reserve, the odds for the Federal Reserve to do another round of quantitative ease in QE number 3 are going to increase, and vice versa. Throughout the month of October, we're seeing a bit more optimistic, more positive economic reports, with a few exceptions. Consumer sentiment there was really, consumer confidence was really disappointing. But for the most part, the U.S. economic data, as I said in the beginning of October, that would be our quest. And certainly, we've seen the U.S. economic data being more optimistic, cautiously optimistic, if I might say. And the Fed acknowledged that at their assessment on the economy outlook after their Fed meeting last week. But they did not completely rule out QE number 3. So throughout the month of November, ahead of the December 13th meeting by the Federal Reserve, we also have to pay very close attention to the U.S. economic data and make sure that there's signs of consistent improvement. October was okay. We'll see if November is going to be okay. Well, next week, unfortunately, looks like a mixed bag for me. Looking at the consensus forecast, the retail sales in the U.S. are expected to show a smaller increase, 0.3% month over month, from rising 1.1% in the previous month. Granted, they're still up, but a little bit slower. Obviously, Christmas shopping is probably going to boost the retail sales number. There might be a little pullback ahead of the holiday shopping. We're starting holiday shopping season here in the upcoming weeks and throughout the month of November and December. So that might be just a temporary pullback. Then we have the Empire State Manufacturing Index also on Tuesday, same time as the retail sales report, expected to show the manufacturing activity in the New York region contracting by only 2, a reading of -2 from previous drop -8.5, which is a smaller decline. So it might also be a little bit more upbeat economic report on Tuesday from the U.S. Then on Wednesday, we're going to more than likely see the U.S. inflationary pressures. Well, I'm jumping the gun a little bit. With the consumer price index coming up on Wednesday, more than likely being non-issue, flat or somewhat flat inflationary pressures is what the forecast is expecting. Generally speaking, the U.S. economic data might be a little bit of a mixed bag with maybe a little bit more of a positive, optimistic undertones again throughout next week. Now, the Bank of Japan interest rate announcement follows the retail sales in the top 10 list of events for me. Bank of Japan, I already said, it will be interesting to see where do they stand on the current Japanese yen strength. The announcement, they don't really give us an exact time for the announcement. Late Tuesday night, early Wednesday morning, around midnight, within ±2 hours difference, around midnight, is when we're expecting the Bank of Japan's announcement, provided, of course, as I said earlier, that they haven't intervened in the markets by then. Then on Wednesday, we'll continue the sequence of important UK economic data. Jobless claims are expected to increase by to 20,000, about 20,000 compared with 17,500 in the previous month. So we can see more people filing claims for unemployment benefits for the first time in the UK. And as a result of that, we can also see the unemployment rate inching a little bit higher to 8.2% from 8.1% previously. Doesn't look like a very strong employment report. And then an hour after that, we're going to see the Bank of England's inflation report, which, as I explained earlier, if the Bank of England is dovish on their inflation outlook and they're expecting inflation pressures to subside after the spike above 5%, they might stay accommodated for longer, and those could be all risk events for the British pound, as I mentioned earlier. In between the UK data, we'll see also the Eurozone harmonized index of consumer prices, which is expected to show the preferred gauge of inflation by the European Central Bank sitting at 3% level. That, however, was not an issue for the new central bank president, Mario Draghi, who at his very first meeting last week decided to cut interest rates, despite of inflation spiking from 2.5% to 3% year over year. So obviously, the European Central Bank policy may not be as impacted even if the index stays at the 3% level. Following the Harmonized Index of Consumer Prices, we'll see the Bank of England's inflation report, official assessment and outlook on inflation. Already explained that could be a risk event for the British pound, especially if the Bank of England is dovish in their inflation expectations. On Thursday, we're going to see, as I said earlier, the Consumer Price Index, Wednesday morning at 8:30 a.m. Eastern Time, we'll see the U.S. Consumer Price Index, the main measure of inflation here in the U.S. The Core Consumer Price Index, which excludes volatile items such as food and energy costs, that pretty much is what the Fed reports, is expected to show only 0.1% month-over-month increase, not a very significant increase, same as the previous month. The overall consumer price index month-over-month is expected to be exactly flat, 0% increase month-over-month. after increasing 0.3% in the previous month. Obviously, inflation is still not that much of an issue for the Federal Reserve, continuing to stay their ultra-accommodative monetary policy course, and possibly even keeping the door open to QE number 3, provided that economic conditions warrant that additional quantitative easing by the Federal Reserve, which could ultimately, as I said many times before, could continue to weigh on the U.S. dollar. On Wednesday, we're also going to see industrial production in the U.S. expected to rise 0.5% month over month from 0.2%. Another optimistic report from the U.S., provided that's the outcome of it. Thursday might bring us also another optimistic report from the Philly Fed Manufacturing Index. Consensus forecasts for manufacturing activity in the Philadelphia Federal Reserve District are expected to increase by 9.3, reading of 9.3 from 8.7 previously. However, Thursday's reports could be a bit of a mixed bag again, because we may have weakness in the housing starts. I'm not expecting miracles from the jobs from the housing market in the U.S. Obviously, with the jobs market still weak, the housing market will more than likely continue to stay weak. Housing starts are a leading indicator of housing market activity, and they're expected to pull back a little bit in October from 660,000 housing starts in September to 610,000 housing starts in October. Building permits are probably going to stay in the 600,000 area. There was 590,000 in September, expected to be a little bit higher in October, 600,000 census forecast. And then we can also see on Thursday unemployment claims a little bit higher after the positive report yesterday. I don't know if you paid attention to it, but unemployment claims dropped below 400,000 with a reading of 390,000 as of the report yesterday. They're expected to climb a little bit next Thursday with the report to 397,000 from 390,000. Yes. So this is the list of top 10 spotlight economic events. Now you are prepared for what to anticipate and what the consensus forecasts are, and you're also prepared for some of the trend development scenarios that could occur next week. I would like to invite you to join me on a daily basis, Monday through Friday, and listen to my daily All Things Forex broadcast. And make sure to visit www.allthingsforex.com for the live program or for the broadcast archives. Thank you all very much for listening today, for attending the webinar. Thank you to our friends at fx3.com. Have a great day and a great weekend, and I will see you again next Friday at 10 a.m. Eastern Time.